All right, thanks everyone. Happy to be with you all this morning. My name is Alison Mangiero. I am the Chief Strategy Officer and Head of US Policy at the Crypto Council for Innovation. We are a trade association. We have a global footprint and we represent some of the leading companies in this space, from exchanges, VCs who support various crypto companies, infrastructure providers, and have spent a lot of time focusing on policy here in the United States. We also have offices in the UK, EU, and in APAC. Very excited for this panel where we will talk about which of these yield strategies actually pass muster when you're going through a due diligence process. How do we think about compliance? How do we think about risk? So very excited to dig into that. But first, maybe we could go down the line and do some introductions, starting with you, Lorien.
Thank you, Alison. You guys are doing God's work. So it's been a busy few years for you guys. So thank you for everything you do. Lorien, Gabel, I'm one of the co-founders of Figment. We're the largest institutional staking provider. I don't know what price they are today, but somewhere between 15 or 16 billion in assets under stake. And our customers are the institutions which we're going to talk about today, like BlackRock and Grayscale and the banks, etc. So looking forward to the topic.
Yeah, my name is Artemiy. I'm VP of Strategic Solutions at P2P.org. P2P.org is one of the biggest staking providers and also DeFi operators. So we operate around like 10 billion and launching a lot of on-chain strategies, vault infrastructure, vaults. So yeah, this is me.
Amir, I just had a panel and I forgot my microphone. I'll go grab it, but you all know me now. So I'm very excited to actually engage in more of these conversations that we're seeing at the institution club. I'll grab my mic.
All right, Amir from Puffer. So maybe just to get started, we've talked a little bit about staking. I think that there's a number of products that now make up the digital asset yield stack. So maybe just to level set from the beginning, let's just map the landscape a little bit in terms of pure vanilla staking, liquid staking, restaking. What are some of the ways that we're thinking about yield in this space? Maybe Lorien, I'll start with you and we can go down the line.
Right. So I do think about it as a stack, and right or wrong, I kind of think of each layer adds either additional risk or a different set of risk parameters. And in our experience, at least, institutions sort of think about the risk parameters more than they do about API in general, which I guess we're going to talk to. But I think you're right. Basically, the original yield in crypto was native staking. It's basically getting paid for running infrastructure for protocols like Ethereum and Solana, et cetera. So assuming there's economic activity on those protocols, the people staking or providing infrastructure should, in theory, get paid for it, et cetera. The rules are fairly well known. The failure modes are fairly well known. There's a long track record. So I kind of think of that as the base interest rate, 10-year treasury bill, money market, riskier than that, but as an analogy. And then from there, you would have liquid staking, which is basically base staking plus a wrapper risk, whatever that smart contract risk is. And then you might have the basis trades, the various vaults, looping strategies, lending, et cetera. And I think as you sort of go up, you'll add counterparty or wrapper, composability, which might be a benefit, is often a risk, as we've seen recently. So I think those are kind of the main. You have restaking in there in the middle, which is staking plus smart contract risk plus a risk of whatever you're security, whatever you're adding security to and governance around that, et cetera. So I think you can basically think of it as a base rate for staking, and then you add on complexity or risk and benefits, maybe higher APY, maybe liquidity, et cetera. I personally think that, as an industry, you should probably be leading with risks first and APY second. You generally have like an AP or is a consumer product. This is what your return rate is, and then somewhere in the small print is the risks. I think actually in the industry, for institutions, we need to reverse that, have a risk map first, and then talk about, you're going to get 200 extra basis points. I don't know. I think we often add in 200, but I'm going on. I'll stop in a second. We're actually adding 200 basis points, but adding like 2,000 basis points of career risk For institutional allocators, like most institutional allocators don't want to get fired. They have a CIO, they have a risk committee, and really the basis points and the extra yield come after those considerations. Anyways, I'll take a break. Sorry.
Yeah,
There
no,
you go.
I mean, I think one thing, just before turning over to you, Artemiy, I think one of the interesting things about this is, for years, I have been saying to people when we talk about staking, when we talk about these things, first of all, we shouldn't even call it yield, right? But I think part of the trap that we fall into is understanding the product and then understanding the risks associated with the product, right? Some of these really are technical risks. And when we talk about diligence, right, there's diligence and there's risk kind of on the financial side, and then there's diligence and risk on the technical side. And of course, those things kind of go hand in hand in these products, but they're different depending on which of these we're talking about, to your point. So anything that you would add on that?
I think now, after this May, when we had 700 million of hacks, and specifically the kelp layer zero Aave hack, is all, it was eye-opening in a way, I think, for the market in general. So now everybody is about risks. Now we talk about technical risks. We talk about financial risks, and it's good. It's good. So at P2P, we always were about security, and only after several years, this literally started paying off in in a significant basis, right? Because before it was let's say just a norm. You get some technical setup, you get architecture, yeah, and but it's risky. Even staking has risks. Even though I agree it's I personally agree that it's a yield, it's the most safe yield. But even in staking, you have slashing, and in the majority of networks, and it also huge risks. So the exposure is significant to the stake. So, and I think it's good for an industry in general. So that we became even business people, not the tech people, became obsessed with this risk evaluation, and that's for better.
What I think is interesting is, to your point, there's always some risk involved, but especially for the folks who I talk to, regulators and lawmakers, things like that, yes, of course, there's slashing risk. There's some risk in kind of your traditional vanilla protocol staking, but slashing events are so rare, right? It's something point 0.001% of ETH has been slashed to date. So of course you want to know you're dealing with a service provider that has a good track record, but I think at that level, the risks are technical and pretty low. I always say it's actually one of the safest things you can do in crypto when you talk about these hacks and these exploits, right? That's a very different thing. I think the activity is very different there. But I know you kind of just talked about puffer and restaking. Where is that yield coming from? Explain a little bit about how we should think about restaking yield in particular, and is that riskier than your kind of traditional protocol staking?
Yep, for us, like I mentioned at Puffer, where there is return, there is risk. There is no free lunch. That's we always say about that. Maybe I'll comment a little bit on that slashing risk as well, that it's improbable or it's very low probability, but you have to put to account that we're trusting 5 major companies with their implementation of their consensus clients. One small bug or one small implementation bug that might produce a slashing event might wipe out a fifth of staking. It hasn't happened just yet, but it can happen, right? So we have to really be cautious of these events as well. Low probability, but probable. So it can happen actually. The way that we increase the stack of yield, we were okay, staking is there, native staking is there, liquid staking is there. It has some minimum returns that it has. How can we gain more of it? Restaking was really introducing ETH as an insurance asset. That's where things really, the initial ideas started. ETH as an commodity, as an asset today is not used as an insurance collateral, right? The only insurance that insures is the chain itself by staking. I'm staking some ETH, I'm ensuring that your transactions are going to be honest, they're going to land. Restaking was another way to really expand that asset to make it more of an insurance asset. We wanted to make it more efficient. We wanted to say, okay, you can get exposure to liquid staking. Why shouldn't we package it in one asset and you can get both the basic liquid staking yield plus the restake return that you can get from this? Of course, with the least amount of risk that you can be exposed to. You will start to insure other activities. An example of it is data availability layers, or AGDA, for example. That's the majority of the paid restaking service today. Another service that we created at Puffer is Puffer Preconf, or Puffer Preconfirmation Network, which provides a fast confirmation to your transactions, like execution pre-confirmation to your transactions. You will, of course, pay more for this pre-conf on rollups on layer 2s, but you will get a higher guarantee of including and executing your transaction. Imagine if you want to purchase some ETH at an exact price at an exact amount of time, we will give you a pre-confirmation under 100 milliseconds and we will execute it in 10 milliseconds. Something that is not possible on the Ethereum network today. That's where we introduce pre-confirmations. But this pre-confirmation needs its own insurance. Where is it coming from? From the restaking that we designed. And we package it under liquid restaking. That's where the yield comes from.
So maybe, Lorien, to go back to something you said earlier, maybe instead of leading with your increased yield is X, we should lead with actually the increased risk is Y, right? How do you think about that here?
So a lot of the risks aren't even crypto basic. So just like at least our journey to the clients like BlackRock or Grayscale over 7 or 8 years has been, they usually start, if it's a bank, it's their clients. If it's an asset manager, it's their ETF. It might be a sovereign wealth fund or or like an institutional allocator from a college endowment, et cetera. But they usually start with some form of crypto hold, transfer, maybe, and sell. And that takes years, or has taken years in most cases. And after that, they'll do buy, sell, hold, and then maybe they'll do transfer, maybe. That takes a little while. And then they'll start thinking about, okay, we have these assets, can we look at yield? And then it'll take them 2 years and sometimes 5 RFPs, as a real world example, to actually understand staking. And the RFPs are 6-month-long process, and sometimes they'll do more than one. And they've already solved custody at this point, which took them a year and a half. And so then you have to explain staking, and then you have to answer literally 200-page, 100-page RFPs, DDQs that usually come back a few times at these institutions because they'll stop if the market crashes, et cetera. And just getting to that stage is 2 or 3 year sales cycles, or has been to date. So maybe that'll change. So I'm pretty skeptical that explaining almost anything that isn't lending, that CIO at BlackRock, after having a drink at lunch, can explain to his audit committee in 5 minutes, is going to be very difficult to get through for most of those institutions. I actually had to make a list of the non-crypto stuff that they care about. So one is the source of the yield. And for most people, the source of the yield is you have someone which you've done a credit risk analysis on, has agreed to pay you American dollars in this amount of time frame. And you know who they are. You've done your credit analysis, whether it's the US government or a big corporation, a car company, whatever. So right there, immediately, most of DeFi fails because you don't know who your counterparty is most of the time. You have to use qualified custody. So if you move your assets out of a qualified custodian, you can't do it because most firms can't have their assets not in a qualified custodian. So the moment you have a DeFi something or other, and one of the reasons staking is you don't have to leave qualified custody, you don't have to give up custody. So once you leave a qualified custodian, you're already done. So every single DeFi thing that requires you to move out of your qualified custodian, never going to happen. You have to be within a qualified custodian. So that's just 2. And then you got to really describe all the liquidity. I'm making a list because the list is so long. That's why there's 100-page DDQ. So then you have liquidity and exit. So you got to be able to describe all the exit and liquidity scenarios and what happens if everyone wants liquidity at the same point. You can't do that for most of DeFi because we don't know And as we've seen recently, what happens when, composability is awesome unless it leads to contagion. So we don't actually know yet what all our liquidity and exit happens in DeFi. So you're fucked there. Can you audit it? Can KPMG, your big four auditor, go in, know the funds are there, track the funds, do their audit that they're required to do every year? Probably not. Like, how do you audit a vault? I don't know. I don't think anyone knows how you audit a vault by KPMG. So if you have a vault, you're gone there. What's the regulatory treatment? You have in vaults, you have curators. Curator, I think, is just another word for registered investment advisor that's not registered. It's investment advice. I don't know what else it is. And so your regulatory status is still unclear. Even the US, even with this super crypto-friendly SEC, you don't really know what a vault is. You don't know what a curator is. I think there are IAs. I think even this super crypto pro SEC is going to get to it and be like, you guys are just providing investment advice. You call it curation, but come on, let's be realistic about it.
Well, there are lines, right? I mean, I think it depends on what the curator is actually doing, right? There's active investment management on the one hand, if it really is truly kind of staying on the technical side. The way I'm thinking about this, and not to get on a vault tangent, because I know there will be a vault panel later, I think about it years ago with staking, right? There are certain things that you can do where it's pure vanilla staking, you're a technical service provider, we're not doing fractional reserve staking, we're not doing all this other stuff, but if you go on the other side...
But we have to go through that process.
To get there.
And we haven't yet. So you're right, you're absolutely right. Some things are going to be investments, some things are not, because you're not doing active investment. But we haven't got there yet. So if you're an institution allocator, I don't know, maybe, but not yet. Counterparties, are you dealing with someone in the US that you can sue or not? Is it bankruptcy remote? Is DeFi bankruptcy remote? None of it is bankruptcy remote, right? It's all pooled assets. So that's not going to work, et cetera, et cetera. And so that's what you get in a 200-page RFP. So I think we're a little ways away yet from anything beyond the first couple things of those stack being adopted by those largest institutions. The smaller institution, there's crypto institutions, there's degens, let's fucking go. But I think that, people who are going to get fired and have to go in front of their audit committee, not going to happen.
So, Artemiy, so you're kind of laughing. Is that because you agree, disagree? Where do you kind of sit here?
Because we are looking through the same 200 pages RFPs
Yeah.
with Lorien.
And this is for staking, the most boring thing in crypto.
Yeah.
That everyone knows. So.
And also the perspective in these RFPs, every RFP is unique from a perspective standpoint. Everybody understands and treats staking, validators, vaults, yield differently. So because they have different profiles. Yeah, that's why it's a little bit one-sided in every time.
When you're filling out these DDQs, and they ask, where does the yield come? How do you describe it in a way that folks can understand? What is your answer to that question?
I mean, it depends. It depends on a product, of course, and I think that with staking it's much easier, right? Everybody, I think, with the ETF approvals, it became already a norm. We see it, and I don't think people questioning the staking yield recently, but what's more important is additional services that can be provided. For example, MEV reward, MEV extraction, additional sharing, block rewards in some networks. So I think it's shifting from standard staking to some additional services. We are also launched already the transaction lending services in Solana and Hyperliquid, and I think getting a additional yield, which is from a supportive products, not specifically staking, is what is interesting for now for the client. This is regarding staking, and for DeFi it's a whole different place, because everybody's doing DeFi molds nowadays, and the strategies vary from T-bills, some safe strategies, LSTs, to some low leverage looping, to some active curation multi strategy. And in this case, carry trade is also a popular one of the popular strategies here. Like yield also comes differently. So it depends on the product and let's say risk profile, risk tolerance. That's no answer.
And on the restaking side,
Yeah, so I believe we just at Puffer we tend to get our hands dirty in solving and answering a lot of these questions.
Yeah.
We go to the bottom of things. Getting liquidity on your exit or an entry taking too long, we're gonna support an EIP to reduce the churn rate. Instead of every 256 epochs, which we believe is unnecessary, we're gonna reduce it to few epochs. So we can enable that liquidity even in a mass exodus without actually get to that weak subjectivity error. I'm not gonna get to the details of the technical side of things, but we tend to get our hands dirty to solve these problems that people see. Another thing that institutions provide, for example, vaults are a very valuable item, but they do have a lot of off-chain activities that nobody can see, which is the transparency issue. I've allocated to this asset that mints a bunch of stable coins without having even a proof of reserves. We've seen that happening before, but they lacked submitting proofs to their users that have allocated to this protocol, so the user cannot even see that protocol. That's some of the problems with today's curators. That's where we're working on fully attested and verified vault and allocations. That comes I touched on it just as slightly on Puffer Guardians. We're probably going to expand that even more to provide on-chain attestation and verification of what was your strategy, where did you allocate. And I agree, this is sort of an uphill. The sales cycle is pretty high. The companies must survive to actually deliver this at the end of the 3-year sales cycle, while crypto itself is very volatile. But we really are optimistic in a way that we tend to get our hands dirty to actually provide this technical visibility and technical solutions to make sure that institutions actually enter. Whether it's restaking, staking any sort of generalized yield, or even if it's about our roll-up stack that we're building, that we just trying to demystify as much as possible. And when there is a path to actually make their lives easier, it will make their lives easier.
so you mentioned stablecoins in the context of vault. So I think stablecoins and stablecoin yield rewards, whatever you want to call it, are having a moment right now. I may be a little bit scarred by the negotiations on stablecoin yield.
What's poly market today?
Yeah.
60%?
If clarity getting done, we'll see.
It's going up.
Yeah, it's going up.
Someone look that up.
The time is
I think we're
now.
over 60%.
Time is now. We're gonna get market structure done.
Right.
But on stablecoins, like Genius Act did pass. Now I'm gonna use my cheat sheet. Stablecoin market cap is up 322 billion, 50% year over year. Transfer volume reached 11 trillion in 2025. Everyone's talking about stablecoin reward and yields. How are you guys thinking about staking rewards and staking yield? Is this all moving to stablecoins? How are you thinking about that piece of it? Any thoughts on that?
Yeah, I think there's a few places where people are actually making money in crypto, and this is the way we look at the market. What are people doing with Ethereum, Solana? Bitcoin's another thing entirely, and then stable coins are clearly the base use case and the real use case for crypto at scale. And so I think it is in one sense competitive with staking. It's at least stable coins that have a yield that's associated with treasury bills and 1-to-1. That's clearly a real form of yield and very safe, et cetera, and probably matches or exceeds a lot of the staking reward rates. But you got to look behind stablecoin yield too, what's going on with your stablecoin. So if the issuer is allowed to do it eventually, and they can provide yield based on treasury bills and money market funds, et cetera, that's one level. If the stablecoin's being turned into something else, then that's a whole nother level. And so I think the same issues will apply to some extent, like what's happening with that stablecoin to generate the yield. You have to ask the same set of questions that we just went through on the prior thing. But I think those are really the two forms of actual yield, and I think it is probably the growing area. So you have to have an offering in stablecoins, I think, if you're going to play in the space.
Yeah, thoughts on that?
Yeah, I think stablecoins are very good for staking. I see them that the more stablecoins are being issued, you're actually you need more security for where they're holding them, right? Like Ethereum as a network is actually a very good place to secure these stablecoins issued on chain, and therefore the premium paid for the security of the network, which comes from the staking, is going to increase. ETH as an asset has its own economics. It has EIP 1559, which burns a bunch of gas at times. I have seen even conversations around reducing the issuance curve on ETH, which can potentially increase the price of ETH itself by very much. So even a very low staking yield might be actually represented as a much higher yield. So I see it as the more activity that comes to the network, whether it's stablecoin yield or stablecoin activities, it's going to really help staking and ETH as an asset, and therefore the demand for staking might increase naturally, like followed by that.
Yeah, and it goes the other way too. Like I remind people all the time because they say, "Oh, why should we care about staking?" And I'm like, if you care about stablecoins, you need to care about the networks that they're built on top of, which are largely proof of stake networks, and you need to care about the security and the maintenance of those networks. So on top of caring about the yield, you actually need to care about this full stack if you want to see continued growth in stablecoins. So I think those things really do go hand in hand, and that's incredibly important kind of as we look forward. So maybe just bringing it back to the panel title as we come to the end here. Which of these yield strategies do actually pass institutional due diligence? Give concrete answers on that. Maybe we'll start down here and go this way.
Yeah, so I still have a feeling that liquid staking and native staking have passed for a while. It's been kind of the hurdle of like how people see these packaged liquid staking. So that's already been passed. Restaking being very close next, in my opinion. I believe like it might not have a lot of attention right now, but restaking naturally has a lot of value once the protocols, once people actually like everything evolves. That's going to be next in line, given that the risk parameters are very well defined, right? Like we don't want to do a restaking that you can get negative 100% yield in one action. So that's probably not going to happen. But next after that, of course, like I categorize. I say like stablecoin yields, especially like treasury bills, were there forever. But if you're making them liquid in like a yield-bearing stablecoin or yield-bearing asset, that's going to be even better. So I say that's not already been passed. Like people are already over that. Especially like it's so much easier to freeze asset, KYC asset, like other issuance on something like a stablecoin. So that's already been like a low barrier to entry. But native staking and liquid staking are an easy pass. I think the next evolution of everything, which is going to be that very interesting topic you brought up, which is curation and vault management, which is down the line because it's very efficient for users to use it. It's very accessible, much more accessible than today's investor advisors that are like really engaging. It's basically a vault. You're like, I have a bunch of USD. I might not get access tonight to Fidelity investment to go manage my money and make a lot of money for me. What if there is a vault that can actually allocate to US stocks? It can have like variety of strategy that can make money for me, like a very safe, like 8% return. That's where these vaults like, it just gets to a very efficient market, and hopefully that's next in line for institutions to adopt.
Yep, I agree with Amir, and also you mentioned all this momentum on stablecoin and earning, and the TVLs are growing, and so on and so forth. But in the majority of this TVL is concentrated in lending, in Aave, and Morpho, and some other protocols. So, and I think this is like on top of staking. Liquid staking, or specifically for stablecoins, I think that stablecoin lending is a strategy which will stick and which will adopt, and also a strategy which a guy from BlackRock can explain to anybody over like. Yeah, or over a drink. So yeah, I think that's a good sanity check and indicators for if it sticks or not.
Yeah, I agree. I think you'll probably see some experimentation with lending at the institutional level, whether it's actual lending or DeFi lending. I think you'll probably start seeing people playing around on Morpho and Aave. I don't know, even liquid staking, which I would think would pass all that long list. I don't know if there was going to be a job, you would have seen the ETF issuers do liquid staking at scale because they have liquidity issues on short redemption periods. You really haven't seen it. You would think you do have a huge Lido, very deep liquidity, et cetera, and that would solve their redemption, in theory, solve their redemption issues, and they still haven't done that. So I don't know. I think beyond native staking, maybe liquid and some lending, that's about where you're going to get.
I was going to say to talk about something even less sexy than staking, structuring for staking ETFs. I think part of the issue there on the liquid staking front is we did get a good revenue procedure from Treasury in terms of how to structure these things,
Yeah.
but they're single asset. And so I think there's an open question around the native asset, the LST, are those the same asset? Can you hold them in the same trust? Like, there's still all of those questions that I think people are still figuring out. So there's the business case, and then there's also those things kind of going on the side. Okay, do we have time for questions? Any
Very unsexy for
questions?
Miami.
Very, very
We
unsexy
should've
for
done
Miami.
it.
Sorry, guys. We'll do something different later. Any questions from the audience?
Yeah, there we go.
Are you seeing any institutions allowing you to be able to lend against your ETH stake? So any banks, for instance, solving the liquidity in, liquidity out, as opposed to having to use stake in full?
Yeah, we had conversations, but no one's done it yet. Some of the people like, I don't know, I know Falcon X does some lending against that. For smaller institutions will want it. I don't know the biggest ones have done it, but yeah, there's been a little bit of interest in that. So I think people are interested in that. You find out as long as usually you got to have obviously the custody issue figured out. But yeah, I would say some of the smaller, more risk on have looked at it. So yeah,
What margin are they looking to take up to?
I don't know. I can get back to you on it or tell you someone who knows. So, but definitely I've seen those discussions come up.
Other questions? All right. Well,
Them all. Awesome.
that's it. We have them all. Thank you. And please join me in thanking our panel.
Thank you.